Welcome to Private Asset Management's Week in Review. Today is Friday morning, May 27th. I'm Dillon Hakes. I'm joined by our Chief Investment Officer, David Allen. David, it's been a while since I've gotten to say this, but very strong week for markets this week.
Yes, a much better week this week after second consecutive week-over-week declines in the S&P 500. It looks like we're set for not only a positive week, but perhaps the second best week that we've seen so far this year.
David, what's been driving the strength this week? What have we learned?
Well, over the last several weeks, we've been discussing sort of pressures in equity markets coming from both the bottom up, coming from companies and their outlooks for the rest of the year, as well as some of the top-down concerns that we're seeing in the global macroeconomy. On the bottom up side, we actually saw some increased outlooks from major retailers here in the US, which suggests that some of the pessimism that was building last week about the retail environment maybe was overdone, and there's a bit of a more of a mixed outlook for retail overall.
We've talked about three major news stories this year. We have the war in Ukraine, we have the Fed raising interest rates, trying to fight inflation, as well as the lockdowns that are going on in China. What have we seen this week? Updates on our three major top-down stories.
Well, I'll take the war in Ukraine first. Really, not much change there, but in fact, stasis in that story might be something that's being positively received by markets. In terms of China and their COVID lockdowns, we've actually seen some improvements. Some of the lockdown conditions are beginning to ease, a little bit more activity, as well as a bit more force coming from policymakers in China about how they plan to respond to the economic slowdown that they've seen. And then finally, and perhaps most importantly, both the inflationary and monetary policy outlook here in the US. We had Fed minutes, which I think provided a bit more certainty for the Federal Reserve and what their plans are for the rest of this year.
What exactly did we learn out of the FOMC this week?
The Fed released their meeting minutes from the meeting 3 weeks ago, where they increased interest rates by 50 basis points and announced that they were going to begin their balance sheet runoff on June 1st. I think what we learned in the minutes is that the committee broadly is very confident in economic growth, and they are confident in the economy's ability to withstand the interest rate increases that they plan for the rest of the year.
It sounds like we've gotten a little more certainty out of what the Fed's policy going forward is going to be. They're obviously trying to fight inflation. We got a big report this morning. We got the PCE report. What did we learn, David?
Right. So PCE is included in the personal income and spending report. And what we did see is that, just like in the CPI data earlier this month, that PCE inflation is trending down. So core PCE year-over-year growth there fell from 5.2% to 4.9%. So breaking that important 5% growth threshold. A great sign, and showing that the policy tightening that we've seen so far, some of the tightening in financial conditions, is certainly having the intended effect.
Tying everything together, how is this affecting actual interest rates in the market? What are we seeing this week?
As equity markets have rallied this week, we haven't seen a big move in interest rates. On the ultra short end of the Treasury yield curve, we've seen rates move higher, but on the long end, we've seen some modest declines. In general, we've seen a steepening of the spread between the 10-year Treasury and the 2-year Treasury. The biggest, the most notable move in interest rates that we saw this week was a pretty significant decline in mortgage rates. That may have something to do with the weakening housing demand that we touched on last week. But in general, it should have some positive effects on housing affordability heading into the summer.
David, we've been talking for several weeks about how attractive valuations look in markets. It seems like what we're saying and what we're seeing from an economic data standpoint is that the picture is really not all that bad. We have markets that have sold off dramatically in the face of really not that bad of an economic picture. Is part of the strong move this week explained by people taking advantage of attractive valuations?
I think so. So we continue to see the S&P 500 trade right around a forward price to earnings multiple that's about on the 10-year average. And amid that, we're continuing to see higher EPS estimates for the next 2 years. So, analysts are expecting growth in the S&P 500, and valuations, as you mentioned, look quite attractive from where they've been over the last couple of years. So I do think, amid a little bit more certainty in the economic outlook, some improving economic data, there's certainly some equity market investors that are taking advantage of those conditions.
All right, what do we have on the agenda for next week?
Next week's big economic report comes from the labor market. So the employment situation report, we're expecting to see 325,000 non-farm payrolls added, and for the unemployment rate to trend down slightly to 3.5% from 3.6%.
We'll look forward to that report next week. Thanks everybody for joining us for Private Asset Management's Week in Review. We'll see everybody next week.